Hi everyone, Stacy Whiter here on behalf of Campus Mortgage with an ATR QM Basics Refresher 3-part series. Now just a quick reminder before we get started, this video is for informational purposes only and should not be considered legal advice or used in place of the CFPB guidelines. Also, this video was issued on July 3rd, 2018, and the information contained in this video is subject to change without notice. So let's take a look at a little bit of the history and background of the ability to repay and qualified mortgage. So as a response to the financial crisis in 2008, the Board of Governors of the Federal Reserve System implemented this rule under the Truth in Lending Act. And what it did was prohibit lenders from making higher price mortgages without considering the borrower's ability to repay the loan. So then from that, the Dodd-Frank adopted a similar rule, not the exact rule, but a similar rule in 2010, which applied to most closed-end credit residential mortgages. And then Congress also established at the same time a presumption of ATR compliance for a certain category of qualified mortgages, which we'll explain here in just a little bit. And then the final part was the CFPB then adopted a rule that implemented the ATR QM as we know it today provisions under the Dodd-Frank Act in 2013. So here's important things to understand. As far as a non-QM loan, and that's probably a term that you'd hear, but Fannie Mae and Freddie Mac have limited the loans that they purchase, and they will only purchase loans that are qualified mortgages or QM ATR mortgages under the ability to repay rule, including those meeting the special or temporary qualified mortgage requirements. So in other words, Fannie and Freddie will not buy a non-QM mortgage. Also, they will only purchase loans that are exempt from the ability to repay requirements, such as investor transactions. And we'll talk about what loans are excluded shortly. So let's take a look at some of the basics. So the ATR QM rule requires that lenders make a reasonable good faith determination before or when they consummate a mortgage that the borrower has the reasonable ability to repay the loan. So they have to make a reasonable good faith determination. So that means that the underwriter should consider the borrower's income and or assets and employment if they're being relied upon against the mortgage loan payment, ongoing expenses related to the mortgage or the property that secures it, payments on any simultaneous financing that is part of the subject property, other debt obligations that the borrower has, such as alimony and child support payments, installment loans, student loans, all of that. The rule also requires that the lenders consider and verify credit history. Now, when it comes to qualified mortgages, so that's where it gets a little bit confusing. If a mortgage has met all of the ability to repay requirements, then there is an automatic assumption that it is a qualified mortgage. But qualified mortgage also has a little bit of its own definition as well. And typically a qualified mortgage cannot have any certain risky features such as interest-only payments, negative amortization, or terms longer than 30 years. There's also a limit to the points and fees that can be charged to the borrower. So for a loan to be a qualified mortgage, it also must meet certain underwriting criteria. And the purpose or the thought process behind this, again, is to protect borrowers, but it's also to protect lenders. So if a lender meets the ATR QM requirements, which is why it's so important, one, it allows them to sell the loan to Fannie and Freddie, but also it protects them in a sense from being sued by a borrower later on saying, and again, I'm not an attorney, this is not legal guidance or anything like that. It's just, a very basic summary of the rule, but basically it can give certain protections to the lender so that the borrower cannot come back later and say, I'm going to sue you as the lender because you gave this loan to me knowing I couldn't afford it. So that's really what it boils down to. Now, the ATR-QM rule also implements other parts of the Dodd-Frank Act that limit prepayment penalties and require lenders to keep records or documentation showing that they met the ATR and QM rules for up to 3 years after consummation of the loan. So what's excluded? What loans are excluded? Well, this is not an all-inclusive list, but these are the most common. HELOCs, any open-ended credit loans, reverse mortgages, temporary or bridge loans with terms of 12 months or less, construction phase of with 12 months or less, so a construction loan, the actual construction loan part, consumer credit transactions secured by vacant land, and just some other examples. Streamline refinances, FHA, VA, HARP, obviously, because in a lot of those situations, they're not going to be showing income, assets, things like that. All right, so that concludes part 1 of this 3-part video series. Please make sure you check out part 2 and 3 where we'll talk more about this. Thanks so much for watching. For more tips and videos, please visit campusmortgage.org to look for their weekly mortgage video tips designed for all mortgage professionals, including underwriters, loan officers, processors, closers, and post-closers. See you next time.